you're asking a question, just so we don't get too much background noise from delivery people, dogs, whatever is going on where you're working? Okay, we'll kick off. Great. So welcome everyone. Fantastic to be able to put on this session this afternoon. I'm joined by Luke Harris to my left, your right, as you're looking at us, I think. Luke, I know, knows quite a few of you already and has spoken to quite a few of you, but Luke works on looking after the relationship between Quilter Cheviot and the Julian Harris advisors. My name's John Long. My role in all this is to look after the head office relationship between Quilter Cheviot and Julian Harris. And also, the most important person here today is Anthony Webb. So Anthony is a portfolio manager that runs our managed portfolio service, and that's what we're here to talk about. So I know some of you have already recommended Quilter Cheviot's managed portfolio service. And if you're in that category, we're extremely grateful. And hopefully today's session is a really, really good opportunity for you to hear directly from the portfolio manager, ask any questions you've got and all that sort of stuff. For those of you for whom this is a newer proposition, hopefully what you'll find out is something about a very, very different way of managing a managed portfolio service that's unique in the marketplace, and hopefully by the end of today's session you'll be concluding that this way of doing things makes a huge amount of sense, and potentially much more sense than a much more kind of traditional approach to MPS that you might be more used to hearing about. The managed portfolio service solutions are available on most UK platforms. So I would have thought, however your advice process works, whatever platform you're using, this will be an option that's available to you. Without further ado, I'm going to hand over to Anthony. If you've got questions as we go through, we're very happy to take interruptions. Just raise your hand and we will come to you as and when we can. But Anthony, over to you.
Thanks, John. Apologies in advance to you on the call if I caught a bit of a cold. So if I start coughing, you have to bear with me for a bit. But we will kick straight off, and I'll run through, our MPS, how we do things, how we see the broad market in the MPS world. Firstly, the landscape, and maybe a bit of background about myself. I've been at Quilter Cheviot since 2010 and been on the MPS team since 2012. So the vast majority of my career has been over the period where MPS on platform has really kind of started off as a service that was offered by DFMs, and it's grown hugely from those early days to where we are now. Industry expert estimates are that there's about 150 billion invested in MPS on platforms, and roughly double that in multi-asset funds also on platforms. So kind of gives you an idea of the context for the MPS landscape. But our kind of view and my career that's been spent running and working on managed portfolio services is that there is quite limited flexibility when it comes to choosing the funds you want to incorporate within your portfolios, particularly if you want to then have those funds consistent across all portfolios. We see a lot of pressure from advisors and from clients, particularly post MiFID II and Consumer Duty, on scrutiny of costs as well. And then also, alongside that, delivering a service that clients actually understand is becoming more and more challenging. The kind of contrast between complexity and sophistication versus keeping it clear and understandable for a client is one that we believe a lot of providers struggle with. And so a few years ago, I pitched to the business that we would build our building blocks and restructure the way we run our MPS. And this is something we delivered in 2021. And what that means is looking at the building blocks, these are 8 funds that we run within our MPS. So they're constituent parts. They are the model holdings within our MPS that we use in different weightings to deliver different risk-weighted portfolios up and down the risk spectrum. So we have, in that central column, you can see 4 equity funds, so UK, US, European, and Asian emerging markets funds. Predominantly, these are direct equity derived. So the UK, US, and European funds have got almost exclusively direct equities within them. But we still utilize external fund managers where we see fit. So, for example, in small cap in the UK, US, and Europe, but also in Asian emerging markets, we will use expert external managers, guys with teams on the ground in their local regions, or that know the macro of China and India and so on and so forth. So it's absolutely a combination of using direct equities, external funds, fixed interest. If we look at the 2 fixed interest funds, we can buy direct gilts. Again, a very highly liquid market there. We don't really need to pay an external manager to get our gilt exposure. It's just about managing your interest rate risk. Whereas in the credit space and corporate bond space, we will still outsource to credit managers where they have that specialism, that knowledge of all the different issuances of bonds across the corporate credit market. And then finally, the 2 alternatives funds, alternative assets and device flow returns. These are the home for all of our non-equity and bond allocations. So property exposure, our alternative hedge and absolute return funds, private equity and infrastructure and so on. So anything else in the portfolio that we can see an opportunity with, that can diversify away from equity and bond returns, we can incorporate into those 2 funds. So that's kind of how our portfolios look. Over the page, you can see we've got 7 investment portfolios, from global growth down to cautious. These covering all the different levels of the risk spectrum. Global growth being 100% equity with a global focus, and that's kind of there for your long-term investors, 7 to 10 years. In clients that are in that kind of aggregation phase of their investment cycle, down to a cautious portfolio at the bottom, which is 20% equity portfolio, predominantly fixed interest and cash. So for your lower risk, high yielding portfolios, and everything in between. But they're all comprised and blended together using the same building block components, and that gives us a consistency of narrative, componentry, outcomes, but then spread across the risk spectrum. And then on fees, we charge a 25 basis points annual management charge. So that's a portfolio level fee. And then we do not charge any fee for these funds, for the building block funds, for the components. So there is 0% AMC or FMC for the building block funds. So that means when you factor in the direct equity allocations that we have, the underlying fund exposures, cost of the structure, you get an underlying cost of about 20 to 30 basis points. Plus you add on our fee of 25 bips, and you're looking at an all-in cost of around 45 to 55 basis points. So basically around 0.5%, depending on the investment strategy that you're invested in. So it's very low cost for what is a fully active investment solution. So I'm going to run through what we consider to be our 5 key benefits of taking this approach. And again, if you have any questions on how we do it or any thoughts on the topics I'm covering, please do just unmute and interrupt, and I'll be happy to discuss them. So firstly, as I've already alluded to, the active at low cost. So if we turn over the page, so this, as I say, is an already fully active proposition. We like to kind of ask our advisors to consider their solutions that they're using and ask, how active is it really? Now, we know that cost budget has forced many DFMs and products providers to move down towards index tracking and incorporate more and more trackers within their portfolios, because ultimately, the pinch has got to be felt somewhere. Everyone's got to get their fees, advisors' fees, DFM fees, platform fees, and underlying fund fees. So we're seeing more and more MPS solutions and overall investment solutions that are predominantly passive, that effectively are maybe actively managed at the asset allocation level, but the underlying constituents are at least 50% or more, sometimes exclusively with index tracking components. And that has actually worked, really well when you look over the last cycle, the last 10 to 15 years, particularly when you consider what's been driving markets forward over the last kind of 10 years. It's been, a falling yield environment post financial crisis. We've seen US exceptionalism. We've seen, as I say, yields falling. We've seen US tech have exceed anyone's expectations for the level of growth that they could deliver. And I suppose the question that we would have is whether the next 10, 15 years are going to look like the 10 years that we've already just seen. And it would seem as though it's unlikely that we're going to get the exact same background that we've seen over the previous cycle. And so then the question becomes, what are your structural exposures? So we've already seen, for example, if you take a purely passive approach in the gilt market, as some providers have done, then you're wedded to the duration and the risk of the broad gilt market by holding a tracker there, and that can be really damaging for low risk clients. You can also potentially in future, we could have that issue for US exposure, for example. If you're using a global equity tracker, then you're going to have 2/3 of your exposure in the US. If the US goes through a period of stagnation, then that's going to be difficult to move around. Or if you're managing the asset allocation and you're just, you maintain your US exposure, but maybe the US growth comes from the mid and small cap part of the market and not from the large cap Magnificent Seven names that we've seen do so well over the last few years. Again, if you're buying a S&P 500 tracker, which most providers are, you're going to be structurally exposed to these sorts of to returns of those sectors and those investments. So I think the broader question or the broader principle down the bottom is that your investment decisions shouldn't be determined by cost. You shouldn't be from the top down saying, right, we need to get our costs down to below 1% or 0.5%, and therefore we've got to buy these trackers. You should be saying, what are the type of businesses that we want to own for our clients? And ideally, then that shouldn't really have an impact on the cost of the proposition. And that's the position that we're in with our MPS. So I can just show you a read through into our North American equity fund, one of the 8 building block funds that we hold. You can see our largest holding is Microsoft, 7.5% of the fund. For a balanced portfolio, it's about 2.25% of a client's investment. You can see, we've got 5 of the Mag 7 on this screen. We've got Microsoft, Nvidia, we've got Amazon and Apple. We don't have, for example, Tesla, which for the first half of last year was fantastic because the stock was plummeting, and then it rallied quite significantly towards the year end. And we do hold a 2% position in Alphabet and Google. It's not on screen as it's a smaller position, so it's about a half weight to what's in the index, because we see there being significant challenges to their business model coming from AI. So what it means is that we're not faced with this dilemma of if we want to be active and have an ability to deviate from the benchmark, we're just buying active fund managers that have that won't hold the largest constituents in the index, or if we want to hold the big Mag 7 names, being forced into just buying a tracker and all of the other types of holdings that come with it that we don't particularly like. We can be selective and we can buy investments based on their individual merit. And we can, of course, change these weights. Nvidia is a big one for us, that, it was about 1.5% of the S&P 500 when we initiated a position in our building block fund. It's now around 6.5% of the index. We're slightly overweight at 6.6. So we've basically managed that relative position. We've always thought it's growing at a ridiculously high rate, and it's valued very expensively to reflect that. But for the benefit of our tech analyst, it's a stock that we knew that there was a lot of upside potential, and therefore not one that we wanted to be zero weighted to or significantly underweight to. So that's an example of a stock that we've had to manage that position very, very closely, and it's benefits our performance in doing so. So there you go. First point was active at low cost. Secondly, is that a question, or is maybe John, if you could mute everyone, and then I'll crack on. So second point for me is a dynamic investment process. So next screen. So one of the issues that we find generally with running an MPS is that, as John mentioned, we're across somewhere in the region of 15 to 17 platforms. And you can imagine the operational difficulty of running portfolios with, if you're using a traditional format with 20 to 30 external funds within them, maybe you've got an active and a passive, a hybrid, a responsible version, a drawdown version, whatever it may be. You end up with this kind of matrix of portfolios across 20 different platforms. Operationally, if your fund research team come to you and say, oh, the fund manager has just retired from that fund and we don't really like that fund anymore, you've then got to log into all of those different 20 platforms, find all of the different strategies that hold that fund in them, sell them all down, replace them with funds. Hopefully you can get a replacement fund that's the same across all those platforms. I'll come on to that later. The point is, this is quite a huge operational burden to just implement any rebalancing to your portfolios. And it's something I've dealt with throughout my career. And it's something that you can see in industry press is being talked about more and more over the last year or so. We've seen an article from AJ Bell actually in Citywire, an actual platform provider themselves have started launching their own DFM discretionary solutions on other platforms, and they're bemoaning how complicated and difficult it is to operate on other platforms. So it's something I'm very familiar with, having ran an MPS for many years. The only solutions to it outside of having a fund or a hybrid unitized solution is to reduce down your rebalancing. So in these articles, if you read them in the trade press, you'll see that people are either moving to 6 monthly rebalancing and trading less, or they become very rigid in your quarterly or monthly schedule. So some of our competitors, for example, you can go on their website and see every monthly rebalance is already in the diary for the year ahead. Or others, that they're going to trade on certain days of the quarter. And that obviously means that you lose out on some of the opportunities that present themselves in markets. And I guess the principle I got down the bottom is that if you want to grow a successful MPS, you need to be across many platforms. You want to hit scale, but you shouldn't be sacrificing your ability to put your latest ideas and to implement, fund changes, security selection, or just reweighting into the portfolio. And I'll give you a kind of a quick example from why this isn't an issue for us. So obviously, with our rebalancing of our building blocks, so much of our trading can take place within these funds. We don't have to log onto the platforms in order to make security selection decisions. So I've picked out from tail end of 2023 around the where we've seen yields rise significantly in 2022. We saw yields continue to rise throughout 2023. We'd been adding duration in the kind of late summer, early autumn of 2023. You can see it kind of marked out on the chart. Our blue line is our fixed interest fund. The light pink line is the short duration 1 to 10 year gilt index, and the darker pink line is the broad gilt index, which has a longer duration of about 8 years. So you can see broadly throughout the year, we were kind of in line with the lighter pink line. And as we were adding duration in kind of October 23, we started to move a little bit more in line with the broader gilt index. And at that point, yields were over 5%. It's kind of similar to where we are now. We were in a kind of sentiment in the market where everyone's worried about inflation. We thought that gilt yields at 5.5 were actually good value. So we wanted to buy into that and pick up some of that interest rate risk. And then pretty soon, it was almost immediately, really, within a few weeks of us doing that, we saw rally into the year end. Suddenly we had a big Santa rally at the tail end of 2023. It feels like a long time ago now. But the gilt market rallied as well, which basically everyone was pricing in a soft landing. If you recall the start of 2024, there were 8 rate cuts priced into the Fed forecast for the year ahead a year ago. So we were coming into the end of 2023 with a very kind of soft landing narrative in both the equity and bond market. So we saw some of the gilts that we've been adding to in the fixed interest fund rally by over 20%. And this was something that was only an opportunity to do in that period. You can see how quickly the gilt market moved, let alone what goes on in the equity markets. Gilts typically, we'd expect them to be a bit more stable, but some of the opportunities to take advantage of the relative value in the wider market, they come around based on timing. Once yields go below 4%, they're not that great value anymore as far as we're concerned. If they're above 5, we'll be buying them. And that's just something that we can implement very quickly. All of our clients that are invested in our building blocks and in our MPS will have that read-through exposure and underlying exposure to those trades on the day when we make them. We don't have to log onto the platforms, and we don't have to wait till next quarter to implement our latest ideas. So for us, this is a really important way for us to be able to invest, to get our latest ideas into the portfolios as quickly as possible. There also comes with benefits when it comes to turnover, because of all of this rebalancing taking place under the bonnet. It means that from a CGT perspective, that doesn't have an impact at the client level because it doesn't trigger a trade within their portfolio. It's all, as I say, under the bonnet within the fund. So third benefit is the consistency, so that we're consistent across all platforms. One of the key challenges of running a traditional MPS is that all of the platforms that you can choose to operate on have different fund availabilities on them. Some of them will have a really wide range of funds, but don't have very good share class availability. Some of them just don't onboard new funds. It's quite a challenge to get the platforms to onboard new funds because ultimately their primary focus is keeping their clients and advisors happy. They're not too interested in onboarding a fund so that a DFM can get their smart new idea into the portfolio. And even if only if you engage with 20 platforms and half of them, 10 of them say yes, we'll onboard that fund, and the other half don't, you then face this issue where do you decide to add the best fund onto the platforms that have it? Do you level down and sacrifice your best ideas and aim for consistency across the board so that you're reporting on it? One thing to really remember when you're looking at an MPS provider is that when you flip over their fact sheet and read the disclaimer, and they'll have some sort of caveat there saying that the holdings that are quoted, the returns, the investments, the share classes, everything is based on a best endeavors basis. You'll have differences according to the platform that you select, and that's because it's just so hard, too difficult to model all those different iterations, all those different substitutions that you may have to make when duplicating across all the different platforms. So this, I think, is a real challenge, and it's a total blind spot for advisors and for clients because, funnily enough, the platforms don't really make much noise about the fact that they're not interested in adding new funds or onboarding the cheapest share classes. It's not really in their interest. It's also not really in the fund houses' interests to lobby all the platforms to load their cheaper share classes, because why would they want to, decrease their revenues? And the DFMs themselves that are running traditional MPSs don't really want to go out and talk about the impact on the substitutions and the impact that that's having on their returns, because it undermines the quality of the proposition. So as I say, it's a bit of a blind spot. What we can demonstrate with our strategy and with our approach is that because all of our building blocks are consistent, they're the same share class, it's just 8 funds. If we can load them onto a platform, then we can operate on a platform. So that's just the only kind of tick box that we have to get past. Once we've loaded our building blocks onto a platform, we know that we've got full consistency across all 20. We know that there's no share class differences. We know that the cost and the performance is going to be exactly the same across all of the platforms. And then it means that for you as an advisor, if you've got clients across 3 or 4 or 5 different platforms, you can make your decision of which platform to use based on the commercial deals, the administrative quality, all the rest of it, the service level that you get. You can know that the outcomes that you're selecting for the client are not going to vary just because you've chosen a platform and you didn't realize that the funds that you thought you were getting aren't actually available. So I think this is quite an important one and something that isn't really talked about, across other MPS providers, because frankly, it's a bit of a stain and a disadvantage to their propositions, and one that we don't have to face. Taking it in another direction as well, we talk about availability of funds. The alternative space is an area that it's just so difficult to get alternatives onto platforms. Firstly, if you're looking at closed-ended, so infrastructure, private equity, closed-ended fund products, they're very difficult to get on platforms. You can't really hold them in a model portfolio structure. Your absolute return and hedge fund names as well. Some of them more kind of boutique and differentiated propositions aren't available across the retail platforms either. So it's a real advantage to us to just be able to load our 2 alternative funds onto the platform, and then we can buy whatever alternative fund holdings we want to within the structure and not have to deal with the fund availability on platform. So as you can see, we've got absolute return in there, we've got property in there, which means we can hold REITs as well as bricks and mortar property funds. This also has the additional benefit for us being able to really broaden out the number of holdings that we have and not be forced into the largest and most liquid, but then also most at risk of gating bricks and mortar property funds that are typically on the platforms. As I mentioned, infrastructure, private equity, so those long-term investment opportunities that you need to be able to time your entry point to, because they move to discounts and historically have been at premiums, but currently at quite wide discounts. So you want to make sure you're buying into these funds at the right time when they're at best value, and that's just something that we can do within a fund structure. It means that if a client buys into the MPS, their money goes into the fund. It doesn't necessarily within the fund go straight into the infrastructure. It's according to when we time it, how we trade it, and our dealing team, how they implement it in the market. So we've got that kind of ability to separate away from client-driven flows, and we can raise funds and invest new funds according to where the opportunities are. Excuse me. So point 4 is about trade execution, and again, quite an important one when it comes to MPSs operating on platform. A particular kind of bugbear of mine, and I'm not sure, to what extent people really realize how platform trading operates. And they're all slightly different, but by and large, most platforms trade on a sales then buys basis. So what that means is whether you're running an MPS portfolio or a advisory portfolio, if you submit trades for the day, what the platform will do is it will look across all of the trades that hit the deadline for the cutoff at midday typically, or maybe that, or maybe close of business. They'll add them all up, take all the sales and send off the sales, and then they'll wait for the price to be confirmed back from the fund houses. And once they've got all of the sales back for that particular client or client base, they will then wait for after they've got that sales price back confirmed, then they'll submit the buys. And the reason they do that is because if they didn't, if they were just leaving themselves open to market movements, then they could find themselves very, very easily significantly in the hole if, for example, a fund were to gate, or if the market was to move and the sales were not going to be worth what they thought they were. So they pretty much have to operate on that basis. And what it can mean is that it can effectively mean that your client is out of the market for their turnover, because it's the weakest link in the chain, and a lot of fund houses don't release their prices until well after close of business. So if you've got, for example, a Vanguard S&P 500 tracker, that it's a very widely held US tracker. It's a very good tracker. It's very low cost. Many portfolios will have that in, many DFMs and investors will have that within their portfolio, but it doesn't price until 9 p.m. because it waits for the US market to close. And so what that means is if you're selling any of that, a very widely held US fund, if you're selling that, then you're not going to get a close of day, end of day price that's going to hit the close of business at 5 p.m., which a lot of platforms operate to. And therefore, you're not going to get the corresponding buys through until a day later. Other examples would be Asian emerging markets, where you can't get your sale down until the following day, because they will trade often at 6 or 7 a.m. or have 9 a.m. cutoffs. So the trade won't go through until the following day. And then obviously, if you factor in anything like overseas bank holidays, if you look at some of the alternative funds that have 2-day pre-warning trading profiles, what we used to see in our old MPS before we introduced the building blocks was that it would often be a 4 to 5 day wait before, after the sales were priced, before our buys were actually delivered to the market. And as I say, what that means is that any turnover in your portfolio is effectively introducing a cash drag. And again, this is just something that is a reality of operating on a platform for many people. It's something that we're able to mitigate to a large extent with our building block approach. So all of our building blocks price at midday. We know that our ACD gets the prices out back to the platforms before close of business. They will still wait that overnight. So they'll still wait 1 day overnight before they place a buy. So we will be at the market when we rebalance for 1 day, but our turnover is quite low. We're only ever trading in the funds, as in trading the portfolios, when we have an asset allocation decision to put through. So if we're topping up UK and trimming US or something like that, that's the only in times where we'll have to trade in the portfolios. Most of the time, as I mentioned earlier, our trading's all done under the bonnet. And that means that we're sheltering from CGT, and we're sheltering from this issue of higher turnover and cash drag. Again, just to remind you, this is not something that you're going to witness on a fact sheet. It's the sort of thing where you could be meeting the client in 5 years' time and say, oh, well, this MPS portfolio has done well. According to the fact sheet, it's up 30%. And they look at their portfolio and say, well, I'm only up 20, 25%, whatever it may be. And they'll think that it's all down to your fees or something. And actually, inefficiency of trading can knock quite a lot of returns out, particularly if you're thinking quarterly rebalancing, 10% of the portfolio being turned over out of the market for 5 days. This could be, 20 business days a year where you're out the market at 10% of your portfolio. Over the longer term, that's going to be a drag as markets generally rise. So, final point from me on the key benefits is the transparency of the proposition. So the benefit of running the dual layer of running the portfolios and the underlying funds. What we see, in the traditional MPS world is that, you end up with, very broad portfolios, 20 to 30 holdings within them. A lot of those holdings are contradictory. So you'll have, a growth manager in there, a value manager, an active manager or a passive manager, things like that. A lot of things that kind of offset each other so that you're not taking as much risk as active funds, single strategy active funds would deliver. But what it means is that it can be quite difficult to explain to the client why you like value in the UK, but you also like growth, or similarly in the US. If you deal with that by kind of leaning more into your house view, then you end up with more concentrated kind of style bets. And we've seen some providers really struggle with that over the last few years. Particularly, we've seen a big rotation, out of growth in the last few years, and then back in to growth in 2023. That's been quite a difficult transition to manage when you're outsourcing to external managers. And yeah, I think that this is the real benefit of the approach that we can have, where we don't have to just rely on external managers. We can deliver the exact positions that we want to our portfolios, and we have full read through and transparency of the funds in our portfolios because we're running those funds. So we have that ability to deliver the narrative directly to our advisors and the clients. So an example just over the page, this is a cut from our quarterly review. And this comes with accompanying commentary too, to explain, what we've been buying, what we've been selling. Just over the quarter, the types of holdings that we have been trimming, the types of things we've been buying. This is all there. I won't run through these right now, but this is all there in our quarterly review. We talk about it in our monthly newsletter. We host a webinar as well. There's also, another thing that I would mention is that throughout earnings season, our research analysts will be in the will be in broadsheet newspapers. They'll be, on the BBC, they'll be on CNBC talking about, Nvidia, or talking about, what's happening with oil companies, talking about investments basically. And they will, your clients will have this holistic engagement with QC as a firm, because they can see what our research process is delivering in the press, is what it's saying, in the Telegraph or the Times or whatever. And then they can look on the fact sheet for their portfolio in their MPS portfolio and see that we've got, that Nvidia holding is there in their portfolio as well, or that we've been adding to it off the back of the narrative that our analysts are delivering. So I think this delivers quite a lot of transparency for those clients that are interested in it. I know obviously that some clients, it kind of goes either above their heads or they're just not interested. So, that's fine. But for those that do like to dig into the detail, we can provide so much of it. There's no kind of obfuscation. It's all there. It's very transparent. And those, as I mentioned, as I showed earlier, on one of the earlier slides, try and jump to, I might just have to skip through these, the North American equity. This is just an extract from our fact sheet. So every month, the top 15 holdings, and this is there for each of the underlying holdings, you can see those holdings within the portfolio. So that's very, very visible, very transparent for our clients to be able to then pull together and cross-reference what's been saying in our updates and what they're seeing within their portfolios. So there you have it. That's all I wanted to really cover today about our MPS and the unique kind of benefits that come with a building blocks approach. First point is very active. It's fully active at low cost. At 50 basis points all in, that's the type of cost level that you can only get to if you're at least 50% passive at the underlying. Most blended active passive propositions are more expensive than our fully active MPS. Secondly, it's dynamic. We can respond to what's going on in the markets very easily, and it's fully consistent across all platforms. So you can use any platform you want. If we're on there, you're going to get the same investment outcomes. It's a very efficient trade execution. So the data that we give you, the model returns, are going to be very representative of what your client's going to receive. It's a very efficient way to engage with platform provisions, and it's very clear and transparent, and we can support all of the trading, all the information that's there. We can deliver to you in various different formats for you either to take on board yourself or to deliver to your clients. So I will pause there for any questions that you may have.
Great stuff. Thank you, Anthony. That's fantastic. Great, everyone. So just a couple of points from me. We will be sending around CPD certificates afterwards, and some of you are only registered with, I think, your first name. So in order so we can get the CPD certificate to you, perhaps you might just drop your full name in the chat box. So I will kick off with a question, Anthony. Do you want to just give us an example of an investment in these strategies at the moment that you wouldn't be able to hold if we just took a more traditional approach to managing our MPS?
Yeah, absolutely. I mean, what I mentioned earlier about the alternatives, that's absolutely an area that you just cannot get exposure to most of the names that we've got within our alternative assets fund. So I'll flick back through on the slide, but may not be in the top holdings. I'm just wondering. So, for example, if you look at the bottom of the list, Harbour Vest Private Equity, this is a listed private equity fund. Returns on it have been fantastic over the last few years. It went through, the discount widened significantly in 2022 as we saw rates rise so significantly. And then, so a lot of listed private equity and infrastructure funds moved to quite wide discounts, and there was a lot of kind of pricing in a potential recession risk at that point. Actually, a lot of closed-ended products, despite the price move damaging the return, for us, and being a bit of a painful place to be for a while. The kind of the locked the permanent capital structure meant that they could continue to operate well. They don't face outflows, so they could continue investing in their best names. So once then the kind of the panic in the market shifts, you can get this kind of geared recovery, both as the businesses grow anyway, and the stability of the economy continues, but then the discount, the pricing down of the assets recovers back. So yeah, Harbour Vest is there. That's one of a number of different private equity and infrastructure funds that we hold. We've also got HD Capital. We've got in the infrastructure space 3i. We've got Assura, a more property focused, IMPP, Trig, the renewables group. These are all, great investments, long-term investments that will deliver a higher level of income and higher income stream for clients, and a growing kind of inflation protected, effectively, income stream that you just can't get it in a traditional MPS unless you, you won't get it in a traditional MPS. You have to buy it within a fund structure.
That's brilliant, thanks. And Faisal Hussein, you've asked whether you should be recommending Quilter Cheviot MPS or Quilter Cheviot Advantage MPS. So you should be recommending Quilter Cheviot MPS rather than Advantage MPS. That's the one that corresponds to Dynamic Planner, which I think is the risk profile that you all use. So hopefully that answers that question. Were there any other questions from the audience?
Just on that, they're both on Dynamic Planner, as in the Advantage one. That's what I've just managed to pull this up from, both the Advantage and the regular ones. They're all on Dynamic Planner. It's just the ones we've just been discussing, they're all the premium ones. The Advantage isn't a premium one, but does have a higher 5-year return. So that hence the question.
Yeah,
the Advantage. Yeah, the Advantage service is ring-fenced for Quilter advisors because it aligns to the Quilter advice process. So our off-the-shelf MPS has its own independent risk process, and we don't align it to the risk process of Quilter Group, which we do for Advantage. So yeah, in terms of accessing our MPS, it's just the standard off the shelf that you would go for, unless you were a Quilter advisor.
Thanks for that.
So we got a question, Anthony, that you may wish to answer, or I can, about changes to the capital gains tax regime and whether that makes MPS less attractive. Our MPS has a kind of a unique angle on this. Anthony, do you want to expand on that?
Yeah, sure. So I kind of roughly covered it when I was earlier when I was talking about the kind of operational benefits of our MPS. The fact that when we want to make changes to our security selection, that it takes place under the bonnet within our funds. What that means is that our portfolio level turnover is quite low. So turnover is the issue when it comes to CGT and when it comes to operational inefficiency, cash drag, all of that. It's all basically portfolio turnover. So the lower your turnover, the better. Now, the more you lower your turnover in a traditional structure, that means you're becoming more and more passive, or more kind of rigid and stable. So we have that kind of unique benefit that we can keep a low turnover by only having to trade in the portfolios for asset allocation decisions. And broadly speaking, our asset allocations are quite stable. It's not like we go from being 80% in equities in our growth portfolio down to 50%. You know, we don't make these big tactical shifts. You know, we're quite, you know, we have quite long held positions there. So as I say, the turnover is quite low. That has a real benefit from a CGT perspective. You know, to give you an example, in the 3 years before we adopted this structure, our yearly turnover averaged about 25%. In the years since, so in the full years since 2022 and 2023, and I've not calculated 2024 yet, but we were 10 and 6% in those last 2 years. So a much lower turnover. So the CGT impact of that is very low. And then secondly, related to that, these are also stable components. So we're never going to fully sell our US building block. It will only be if the client decides to sell. So it means that most CGT kind of activity will be client derived from when they choose to, you know, withdraw cash and so on. So I think, sorry, the short answer is yes, broadly, you know, reducing the allowance and increasing the rate of CGT does make most MPSs less attractive. I think it makes ours a lot more attractive because of that unique structure.
Great, that covers that off nicely.
I think just one thing to add with that as well, John, Anthony, you might know the more accurate stat, but I think over 85% of our clients within a MPS is within a wrapper, so either ISA, SIP. So the majority wouldn't have to consider that capital gains tax.
Yeah.
Yeah, absolutely. Absolutely right. There is someone typing, so we might have another question coming through. Or you can unmute if you'd like to.
Yeah, do by all means unmute. Okay. Fine. Assuming there are no further questions, we'll wrap it up there. But if anything does come to light, sorry, Anthony.
Sorry, a question has come through, and sorry, I did have a slide on performance, which was just in the appendix, so I can just quickly share that if we'd like, okay. And then it will be on the recording at least, so everyone can see it. So here's an extract from our latest webinar, performance to end of year. We've been running the building block structure for just over 3 years. I've got as I say, it's from our webinar, so it's the 1, 3, 6. Sorry, it's a 3, 6, and 1 year figures. So there it is on screen. You can see that versus IA sector, particularly over the 1 year period, we're looking really strong. The global growth portfolio is around 4.5–5% ahead of the average IA global multi-asset fund. Again, in growth, we're a good 2.5%, more than 2.5% ahead of the flexible investment average fund. And then as you move through the kind of mixed asset IA ranges, again, we're ahead for the balanced. The 20 to 60, that one really does depend how much equity you have. So our income portfolio that's got around 50–55% equity in it, that is beating. We're more closer in line with defensive, where we've got about 40%. The conservative one, historically, we've always had it against the IA 20 to 60. It's got about 30% equity in it, so arguably it could be against the 0 to 35, and you can see that the 5.8 against 6 is okay, slightly underperforming, but it's at the top end of the 0 to 35 where you can see it's outperforming. So that just gives you an idea of where we sit relative to the broader multi-asset fund universe and our kind of recent performance.
Great stuff. Okay, in the absence of any further questions, we will wrap it up there. But thanks so much for joining us. We will be following up over the next couple of days with the CPD certificates. Obviously, if any other questions come to light, I mean, don't hesitate to reach out to your usual Quilter Cheviot contact. It's probably Luke Harris here. So if that's the case, just as I say, drop us a line via email or pick up the phone, and we'll happily address any questions as they come up. I hope that's been a really useful overview of the MPS solution. For some of you, it would have been an introduction to the MPS solution. As I say, we're very, very happy to run through that with you this afternoon, and we very much look forward to crossing paths with you again in the not too distant future. So we look forward to speaking soon.
Thanks, everyone.
Bye. Thank you.